We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrick. Joining me today is Danielle DiMartino Booth, CEO and founder of Quill Intelligence and former Fed insider. She's also the author of the book Fed Up. Thanks for joining me today, Danielle.
Great to be back with you.
So, Danielle, during your time at the Fed, were you aware of how important, let's say, the wording was for press releases and how the market would react to them? Or was it not as closely watched by the markets back then?
Well, I think that it wasn't until 1987, I want to say, that the Fed even started to release a statement at the conclusion of its Federal Open Market Committee meeting. So before then, it was, you really had to wait and see what happened, what the Fed did, in your rearview mirror. There wasn't anything formal out there. But once it became a matter of public knowledge, even once, in 1996, they started publishing FOMC transcripts with a 5-year lag. And they really do pour through the detail of some of the discussions. And that was, I think, what was most eye-opening at the time. It's that you would see literally page upon page upon page of deliberations. You're talking about 17 people around a large oval table in Washington, D.C., devoting 40 minutes to the inclusion or exclusion or maybe adjustment of one word in that FOMC statement. So there is a hypersensitivity to it. And that was why initially, when the statement was released after the September meeting, that the markets kind of went gaga over the inclusion of the word lag, L-A-G, one word, and markets took it as a definitive sign. Oh my gosh, they changed the language. They're nodding to the fact that there's going to be repercussions that are felt with a lag after policy has been tightened. And then Powell got to the podium and shot that all to hell.
Yeah, absolutely. And of course, you and I have talked about the lagging nature of this data, really driving by using the rearview mirror many times. And I have a couple questions related to that. But I heard that you came up with a new nickname for Jay Powell. So how did you come up with that and what is it?
Well, so I was on a live TV set watching this press conference. And at first I said, well, gee, he's come a little unhinged here. And then I'm like, okay, he's kind of resembling, Marlon Brando. I'm going to make you an offer you can't refuse. And then things really started to pick up when a Yahoo finance reporter asked him about the stock market going up. And I'm like, he's starting to look a little bit more like Arnold Schwarzenegger, the Terminator. By the time it was all done, I'm like, this is Clint Eastwood. Make my day, Jay. I mean, he just completely let loose and basically delivered with body language, tone, and by completely going off script. In the very beginning of the press conference, he was meticulously reading his answers, being very measured and careful with every word that he said. By the end of it, it was just unvarnished, make my day, Jay.
Yeah, it really seems like it seems like a very difficult position for one person to be in. And, it just makes me wonder why anybody would ever want that particular position, right?
Well, I mean, it's not a position that anybody would envy. And it's certainly not one that he needs, which is something that I've said repeatedly in the public forum. And yet there he is. So what if he's trying to do something that is nobler indeed? What if he knows, you raised the question about the Fed following lagged data. What if he knows it's lagged? Mm-hmm. And that's the question that I keep asking. Capital One Financial has come out for just to take but one real-time example, and it's had its price target and its rating cut by Bank of America because it is already reporting the highest credit card delinquencies, auto loan delinquencies. It's going to wipe the records clean. And we're still just now at the advent of recognizing that the layoff cycle has started. This is a man who follows the financial media. Mm-hmm. He will see just as well as you or me the Capital One announcement. So he will know the damage that Fed policy has already done. And yet, will he choose to continue hiding behind the lagged data if he wants to break speculators' dependence on the Fed always covering their ass? That's the question.
Well, you recently spoke about Carvana being a great example of how interest rates, growing unemployment, the layoff cycle, as you call it, and pulling liquidity from the market. So can you explain that as a great example of, really a holistic view of how these rate changes really start to affect the greater economy itself?
So, just as was the case with subprime mortgages, as long as you could underwrite the mortgage and then hot potato it off to a major lender, and then the major lender, they aggregate all the hot potatoes into a pool and sell them off to Wall Street and investors, as long as you can move the paper, then you can continue going on with underwriting really bad loans. And that was kind of the business model of Carvana, because the asset-backed securitization market that bundled up car loans was able to sell them off. So as long as Carvana was able to get a continuous flow of financing, it was able to pay too much for used cars, loan too much when they would come in for trade-in, for example, loan too much against used cars and keep it going and keep, theoretically making these profits. Now, that works in a zero interest rate environment. That does not work when interest rates are going up, when money market funds are plowing every penny they can into the Fed's reverse repo facility because they can get upwards of 4% overnight, for heaven's sakes. And so banks have to start tempering back how they can allocate their balance sheet resources. So all of a sudden, if you're a Carvana and you've got a bunch of these auto loans and you have to get rid of them to keep this, let's just call it what it is, effective Ponzi scheme going. Mm-hmm. If you can't sell those bad auto loans off to somebody from some poor schmo who paid $40,000 for a used car with 100,000 miles on it, if you can't get rid of that paper, everything collapses. And that's why you saw the day that Carvana disappointed, that Morgan Stanley came out with this adorable, I took a screen print. Morgan Stanley reduces its stock price from $68 to a range of between $1 and $40 a share. And there's, increased odds, the low end of the range, $1. It just recognizes the potential for bankruptcy. Mm-hmm. Talk about going from 60 to 0 really quickly, as opposed to 0 to 60.
Mm-hmm. Yeah, absolutely. So, how do components like, let's say, for example, housing prices start to really move their way through and affecting CPI?
So it's something that we're seeing more quickly than we had thought we would otherwise. We actually saw a slight dissipation in rental inflation, and it's because markets are moving so fast. There was a report out that 50% of the markets in the United States are seeing home prices falling, while another 50% are still seeing home prices at record levels because they're affordable. Mm-hmm. If I'm a millennial and I want to start a family, I'm thinking about Pittsburgh looking pretty, New Haven, perhaps, all of these shunned markets, because the bubble's coming out of the bubble that was inflating the Boise's and the Austins and the Raleigh-Durham areas of that. It's deflating so fast. And that is pure interest rate sensitivity. At the same time, to get into the weeds a little bit, the biggest banks are no longer riding roughshod alongside the Fed, buying a bunch of mortgage-backed securities, which they were doing on a parallel to the Fed when the Fed was still growing its balance sheet, growing its holdings of mortgage-backed security. Now it's like kryptonite. Nobody wants to get anywhere near it.
Mm-hmm. So maybe we could contrast, let's say, the example of housing prices with whatever comes to mind for you. Part of what I've been trying to wrap my head around is trying to figure out how long some of these lagging indicators are really going to take to work their way through the system. We've seen one of the fastest rate hikes in history. And so what I'm trying to figure out is how long it's going to take for the actual effects of this, refinancing debt, things like that, how long that takes to actually be digested by the market.
Well, it's happening more quickly than we thought it was. And that takes us back to Make My Day Jay. And he was saying, well, the full body of knowledge that we have on lag occurred in non-inflationary times when the Fed was always able to loosen monetary policy, make borrowing rates more cheaper than they were. That's not the backdrop that we have today. And that's one of the reasons that he said, maybe lag isn't what we thought it once was. And I would argue that rather than taking 5 quarters, we're now seeing rapid home price appreciation from 3 quarters ago filter its way into the CPI. If it went in at twice the pace that it used to go in, that means by definition, it's going to come right back out at the same pace. And in fact, we have seen, we saw auto prices fall in the producer price index data. We're going to see that continue to be the case as buyers step back. Again, these are little baby Ponzi schemes here and there. But once Main Street catches on, then it really, really is over. And if you look at University of Michigan, the New York Fed, they query households. Where do you see the job market going? University of Michigan and New York Fed both said 43% of surveyed Americans now see a rising unemployment rate. That means that there's been a recognition home prices are falling. That means that there's been a recognition, you know what? I'm not going to buy that car. So rather than, because 12 months ago, it was, we better hurry up and get in there with the bidding war. We absolutely have to go right now. It took a long time. It took a lot longer for Main Street to figure it out than it took for Wall Street to figure it out. But once the word gets down to Main Street, it's party over.
Yeah, and it's really interesting to think about, as you're saying, watching those overheated markets kind of come out. And then with the advent of working from home or working online, people having the ability to move to those, quote unquote, less or cheaper markets. And then once that, let's say that wave finally dissipates, the effect that that's going to have on CPI as well, right?
That's exactly right. And you have to look at, to use the analogy of a wave is perfect. You had this wave of humanity leave the cities, and that sent second home prices to the moon. Well, that was the first wave of declines in home sales. And now we're seeing second home prices fall at the fastest rate. That last wave, as recession sets in, will even affect those less desirable markets, the markets that weren't so hot in 2021. And that's, again, people ask me all the time, recession, are you sure we can engineer a soft landing? And I'm like, people cannot afford inflation. They can't afford to even think about inflation if they don't have an income. It becomes a moot point.
Well, directly to that point, Danielle, how does wage inflation play into the picture here? Have we seen wages keep pace with inflation? And is that, really the issue that really adds to that wage price spiral if people can keep affording those higher prices?
It does. And yet, for everything that's being said about a wage price spiral, I just don't see any long-lasting evidence of it, because companies are turning to layoffs. They are saying, they're saying, if this is what we have to pay per hour and demand is being destroyed, then we're going to cut heads. Again, you can debate the wage price spiral all day long, but if you don't have any wages at all, that's in the aggregate going to take pressure off of wages. Companies can only withstand margin compression for so long before they have to, especially companies with shareholders. And you actually see, it's the smaller businesses that are continuing to compete for warm bodies, where the layoffs are picking up at the biggest companies, world's United States second largest employer, Amazon.com. And people forget this is the second round of 10,000 announced layoffs at Amazon. People are like, but they hired too much. And I'm like, that's fine. I understand. So they went from 800,000 to 1.6 million employees. Earlier this year, they took it down to 1.5 million employees. Now they're taking it down to 1.4 and freezing hiring of another 10. at the margin, the people affected, that's a real economic event. It doesn't matter that Amazon overhired and now they're right sizing. If that right sizing involves somebody's livelihood, you can put a fancy word on it. It still means I have no income.
Well, and I think Amazon is a perfect example, right? Because they need the ability, they hire based on the ability of keeping up with literal consumer demand, right? So if consumer demand is starting to diminish, Amazon isn't going to need as many people, overhiring or not. They could probably grow into those jobs if they had the demand there, right?
Exactly. And the other good example is Walmart, the country's largest employer. Their fiscal year ends, their fourth quarter begins November the 1st. And in their earnings conference call, they noted that in the first 2 weeks of November, they really had seen robust activity in groceries, and that they'd seen a migration of, now we've got high income earners who are trading down to shop at Walmart because they've become price sensitive all the way down the income ladder. Okay, that's telling you that if high income earners are stepping into a Walmart instead of a Whole Foods because their grocery budget's been impeded, what does that say to their ability to shoulder discretionary purchases coming into the holidays? Not much.
Well, and to your point, the idea of high income earners getting laid off or going into Walmart versus Whole Foods, you recently spoke about the idea that those jobs aren't going to be as easily replaced if this, let's say, pace continues, right?
They won't be. And I said to myself, well, are you onto something or not? I actually spent a better part of my weekend researching state by state by state severance laws. And California being a massive exception to the rule. But most of the states out there, if you're receiving a severance package, in other words, not a lump sum, but you're getting paid out over like a 3 or 4 month period, or I got 6 months severance, that state precludes you from applying for unemployment insurance. You can only do that after the company's money runs out, or you're effectively double dipping. So one of the reasons that we've not seen the layoffs that we've read about in Silicon Valley or at Stanley Black & Decker in Connecticut, they laid off 1,000 people in their finance department, all of whom were paid severance. We're not seeing it manifest in initial jobless claims, which Jay Powell can hide behind and say the labor market's still very strong, because they can't apply for unemployment insurance until their former employer's money runs out.
Right.
So I keep saying that we're going to see an employment rate shock. That the same way we've seen so many other indicators, people are like, whoa, housing sales fell off a cliff. In that same manner, I suspect we're going to say, whoa, that unemployment rate increase came out of nowhere. It didn't. Yeah. There's been pressure building in the system.
Yeah, it's such an important point, right? It's, again, the idea of hiding and lagging data that is going to take time to all of a sudden surprise us, right?
Exactly. And I think that the Fed is banking on the big surprise, holding off for long enough for Jay Powell to get in 50 basis points in December. It's kind of cute. My Twitter feed, everybody's like, it's not another 75. And I'm like, they've been saying it's going to be 75 in November and 50 in December forever. So let's just get over it, people, and move on with it. 50 is still twice as big as what we used to be accustomed to.
So, we, of course, recently got the CPI number that came in under estimates, and today we got the PPI number. So was there anything in the announcements that surprised you, or are the base effect comps that you and I talked about last year that were really working in the opposite way last year, they're working kind of for the numbers this year?
So that is one component. And the other component is discretionary good pricing coming off really quickly. So that's a real-time feed through to the PPI or CPI. On the other hand, we could be having a discussion the next time you and I visit about, gee, the core's still hot. Opposite. Gee, the core is cooling off. But at the same time, a cold front just moved through. So, energy prices are higher than they would be otherwise. Thanksgiving turkeys are costlier than they've ever been. Mm-hmm. So food inflation food and energy inflation still very much feeding the headline, which is that's the most tangible form of inflation for 99% of households is what they spend at the gas pump and what they spend at the grocery store. So you could see a situation where you've got the doves saying, we need to back off. The underlying rate of inflation is coming down pretty hard. That's again, that could be something else that Jay Powell hides behind, saying yes, but the headline is what we live. Now there, I would actually tend to agree with him. But again, if financial conditions continue to tighten, you'll still see the ripple effects moving through the real economy in the form of cost cutting and layoffs. Remember, we've had a massive inventory build. A year ago, we were talking about there's no inventory on hand. Mm-hmm. And now you're seeing General Motors say, by the end of the second quarter, we had sent out 75% of the inventory that dealers had been waiting for. We shipped in the second quarter. So there are no semiconductors, that's gone. And so we could see, this snapback in manufacturing. And in fact, what you saw in the first November regional to get published, the Empire State manufacturing survey, is that you saw that production had increased. And that's them clearing out these old dusty backlogs. But the future outlook and the outlook for future new orders and future backlogs, I call backlogs future demand, mm-hmm. collapsed to the lowest since the series started in 2001. So manufacturers aren't seeing anything come behind satisfying the demand for orders that had been in a holding pattern until they got this one missing piece.
Yeah, it's crazy. I mean, I saw an example the other day. I was in a motorcycle shop, and last year at this time, they had no bikes on the floor whatsoever. And right now, you can't even basically walk through the showroom. There are so many bikes there, and they literally don't have anywhere to be able to put them, and there's nobody's buying them either.
Yeah, I've seen the same thing. I was driving from Austin back to Dallas just a few days ago, mm-hmm. and I looked, to the side of the highway, and I'm like, that's a lot of RVs. It looks like they're about to spill over the side of that lot because mm-hmm. they're packed so closely together. Remember the Great Retirement, taking Social Security early, becoming empowered. I don't need this job. Take it, COVID's here, pandemic. It's time to live the rest of my life. Mm-hmm. I'm going to buy an RV and cross the country. Well, now they've got an RV payment and high gas prices. And by the way, Social Security or whatever form of retirement savings they have, if it was in a 401k or an IRA, that's come off. And on top of that, their cost of living has gone up. Mm-hmm. So you will continue to see 55 plus age people trickle back into the workforce because the math just has quit working.
Mm-hmm. You made an important distinction there, Danielle, between, let's say, the doves and the hawks. And obviously, Jay Powell isn't the only person at the Fed. So have you seen a lot more maybe animosity or more fireworks between all of the Fed chairs than we normally would?
Well, I would just say this, that we've gone back to the normality that preceded Jay Powell when he was finally confirmed by the Senate. Mm-hmm. So for a while there, everybody was towing the line. Mm-hmm. You're like, has Chicago's Charlie Evans lost his mind? He sounds like a hawk. Mm-hmm. Well, guess what? His swan song interview as he's exiting the Federal Reserve System after a long career, the dove in him finally came back out. Same thing for Mary Daly, same thing for Lael Brainerd. They're talking about lags. And then you get somebody like Powell's chief lieutenant, who's got his ear, Christopher Waller, permanent vote on the Federal Reserve Board, blows out on Sunday afternoon from Sydney, Australia. And he's like, we're way over our skis if you think that we're anywhere near the end of this tightening cycle. Those are the ones I listen to. You have to be able to distinguish between the ones who are giving Powell counsel and the ones who would wish that Powell would simply go away and let them go back to their business of overly easy monetary policy, zero interest rates, and quantitative easing. That's not happening. And I think we're watching in real time the effective veto power that Jay Powell has. People forget that Paul Volcker had every single member of his committee vote against him, dissent, towards the end of his career. And he still held the line.
Yeah, it's really interesting to think about those dynamics. And as you said, when we see some of those chairs kind of change their tone, that seems to be really, really telling. But it really seems like Powell's trying to let the markets know how serious he really is about bringing inflation under control, and as a byproduct, probably causing a recession in the process. So, do you have any sense of how deep this recession could actually get?
Well, I mean, at this point, you're playing a game of math, and the National Bureau of Economic Research knows that. Mm-hmm. Let's say you have a negative print Q1 22, a negative print Q2 22, and a negative print Q4 22. In this little blip of Q3 being a positive number. Mm-hmm. There are many instances of recession in U.S. history when the NBER has looked through that one quarter of positive growth and said, you know what, the recession really did begin in January of 2022. Mm-hmm. If that's the case, then any notion of short and shallow, it's not going to start until the second half of 2023. But I'm like, well, tell that to the employers who are cutting heads like a guillotine. So, but what I'm trying to say is, if what we're seeing in the fourth quarter and the rapid slowdown in economic growth is just a continuation of what we saw in the first half of 2022, and now we're seeing the big layoffs come through that's going to carry into 2023, that's a long recession. Mm-hmm. The longest one in our memory is the 6-quarter recession with the great financial crisis, right? December of 2007 through June of 2009. We thought that was an eternity. And yet, for a lot of people, especially CEOs and households, they will tell you, and they have been telling you, we're in recession.
So, Danielle, just to clarify, are you talking about GDP or economic growth when you were saying the negative to positive there?
Talking about GDP growth.
Okay.
And what the National Bureau of Economic Research does is they measure output in dollars. Mm-hmm. They measure output in inflation-adjusted dollars. So if they were to see that the beginning of January 2022 versus, say, March 30th of 2023, if that's just, the dollar growth coming down, little blip up, but then continues down on its trajectory, they could easily timestamp the recession as having started in January of 2022.
Right. Okay. Yeah, I just wanted to clarify that. As this is an ever-evolving idea based on the analysis, where do you think Powell's pain point actually is here?
So I think Powell's pain point really is in the credit markets. And I've been maintaining that. We are seeing, we wouldn't have a discussion about Carvana or Capital One if there wasn't already pain manifest in the credit markets. If the asset-backed securitization market or the commercial mortgage-backed securities market wasn't already starting to go into a deep freeze, that's credit. Mm-hmm. So you've got distressed credit, which is those are high yield bonds trading 1,000 basis points or more over their comparable maturity treasury. So Bloomberg just announced today that figure had jumped up to 291 billion, the highest level of credit trading distressed since August of 2020. Mm-hmm. As that continues to rise, as the bankruptcies continue to pile up, that's where I think Powell's pain point will be, somewhere in the credit market, because the credit market is just enormous. I mean, I read a statistic, I wrote about it in last week's Quill. 95% of the $6.55 trillion investment grade bond market is trading at a discount. Now, some of that has to do with the rapid increase that we've seen in interest rates, to be sure. But once credit risk starts to also be reflected in that distressed pricing, you really do risk getting major dislocations in the credit market, which I constantly remind people is much larger than the equity market.
Mm-hmm. Well, kind of on that idea of bonds, I spoke with Joseph Wang yesterday, and we touched on his thoughts about the bond market. So does a yield curve inversion no longer mean recession right now?
Oh, I think a yield curve inversion initially advertised that credit was going to be tightening. Mm-hmm. Now I think that as we tape this, the 2-year 10 years at a negative 57 basis points, a post-pandemic low. Mm-hmm. Level we have not seen since the year 2000. The correct way, in my view, to interpret an inverted yield curve is banks' willingness or lack thereof to extend credit. Mm-hmm. And we have to think about it that way, because if banks don't see the ability to profitably lend, they're not going to. And in a credit-driven economy, which we are, the United States is a debt-driven economy. If the wheels of credit come to a stop, so does your economy. Mm-hmm. So it's not that we have to necessarily dissect the 2s, 10s, the 3-month 10-year, the 3-month, 18-month. It's all semantics in my view. And by the way, I'm friends with Joseph, and I think he's brilliant. Mm-hmm. But I think he and I just see the world through two different prisms. And the prism I'm seeing it through is credit availability or the lack thereof. Mm-hmm. And something else that we follow every single day at Quill Intelligence is the yield curve in credit. It's a whole different beast. If you look, so the triple B rated sector of the investment grade U.S. corporate bond market, okay, it's one rung above being downgraded to junk, meaning I'm Joe Q, Fidelity bond fund manager, and if a bond in my mutual fund is no longer rated investment grade, I have to sell it. Mm-hmm. So that triple B rated slice, if you will, is $3.5 trillion. Larger than subprime was going into the subprime crisis, $3.5 trillion. Mm-hmm. So at Quill, we follow the difference between the 2-year triple B yield and that of the 10-year triple B yield. Mm-hmm. Like in the last major crisis that we had, the closest that those two yields got, meaning credit's going to seize up in this particular $3.5 trillion slice. Mm-hmm. The closest we got was positive 93 basis points. We're now at 48, positive 48, mm-hmm, but half the level of what we saw. Mm-hmm. If that yield curve was to invert, I think we'd really have Jay Powell's attention, because so many things have to break along the way. You're talking about downgrades of triple B into the junk market, and the inability to lend in the biggest slice of the corporate bond market on the planet. Mm-hmm. If you see that yield curve invert, we watch it at every single close.
And of course, liquidity is a big factor that comes into that as well. If that's being pulled from the banks, that's kind of an extra dagger in that part, right? It is
the 2s, 10s, triple B is a pure prism into liquidity or the lack thereof, which is why we also follow every Friday at the close other deposits liabilities. It's the Fed's H8. And we've seen that peak in March and keep coming down every single month. Mm-hmm. And the acceleration of the decline in ODL, Lacey Hunt's favorite metric, mm-hmm, has accelerated as quantitative tightening picked up to full speed in September, mm-hmm, as it should. But again, it's liquidity, and everything is predicated on liquidity being abundant, ... indefinitely.
Mm-hmm. Yeah, it's interesting to be able to have these two conversations back to back here, Danielle, because Joseph thinks that the data that the Fed looks at is accurate and they are acting appropriately based on that data. And I don't get that sense from you.
On paper, he's right. Mm-hmm. But again, the unemployment rate and the inflation, the rate of inflation, these are the most lagging of all economic indicators. Something else we follow, and a buddy of mine on a bond trading desk today said that it looked like a child had put this website together with a crayon. So be it. Mm-hmm. But we follow dailyjobcuts.com. Mm-hmm. So through November 15, not even through the end of the day, but through November the 15th, we've had more than 34,000 layoffs announced. Mm-hmm. If you aggregate the months of August, September, and November, you had 38,000 layoffs. So we're almost mid-month where we were for the aggregate of the last 3 months. Mm-hmm. Challenger Grain Christmas, they announced layoffs. They came out with an extraordinary mid-month report today that said tech layoffs are already north of 30,000. Houston, we've got a problem. Mm-hmm. They never come out in the middle of the month and announce anything. That's how quickly layoffs are going up. It will trickle on through to the unemployment rate. But to Joseph's point, the Fed is technically following the right metrics. That's as if I was to say, my FDX was worth X a week ago or 2 weeks ago. But those paper gains have since been, combusted, annihilated, goodbye. So all I'm saying is the Fed is following, the Fed's getting off on a technicality. God love you, Joseph. Sorry.
Yeah. No, it's interesting to, again, make that contrast and then try to see, where the puck is going kind of thing. Another crazy development, obviously, that a lot of people have heard about was the UK gilts market blow up. And that was obviously, a great example of a shot across the bow for the ramifications of this type of monetary action. So what are the biggest differences between the US pension systems and the UK system? In other words, could we see that same thing happen here?
So the biggest difference is because both pension systems have been sold, and let me be sure I use that verb correctly, sold. It's like, I'm going to sell you this nice used car. Both pension systems have been sold structured notes, trillions of dollars of structured notes. As long as the band of gilts, as long as that yield stays south of this and north of this, then you're going to get, on a levered basis, paid this. Maybe it was sold by the world's biggest money manager. Who knows? So when the peanut butter hit the fan and the bands were broken and the underlying security went haywire outside of those bands, margin calls came in. Well, UK margins must satisfy margin calls with cash, cold, hard pounds. US pension funds can satisfy margin calls with securities, such that they didn't have to go out and liquidate. The UK pension system, they had to go out and sell things to raise cash to satisfy margin calls for the structured notes that they should have never been sold in the first place. US pensions would have a reprieve of sort because they could post other securities in order to satisfy those margin calls. Critical distinction. Great question.
So does that create an advantage here? Or does that create, eventually a bigger problem if those securities are also at some point also become illiquid?
Right. And so I'm picturing like Bugs Bunny and tossing back and forth, a bomb, from one cartoon character to another. And all of a sudden he's like, how did I get two bombs instead of one? You take both of them. That's kind of what you described to me. It's because, again, I go back to, pension funds, massive holdings of BBB, investment grade, money good bonds that the credit markets are telling us are at risk. So what if you have a structured note and the security underlying that you were going to use to satisfy the margin call? What if both are imperiled?
Yeah, it's crazy. And to your point about FTX, the Ontario Teachers Pension Fund had $95 million worth of exposure to FTX. And that saga is, of course, still playing out as we speak. So aren't pension funds supposed to be investing in much more boring types of investments than crypto exchanges? Or could this be really a massive regulatory oversight?
It is without a doubt. A word on regulators. I think that they want it for crypto to go away so that they would never have to figure out what it was, so that they would never have to regulate it. I don't quite think that they anticipated it was going to go away like this. So it becomes a huge problem because, they're like, hear no evil, see no evil, the regulators. But what if it's in your public pension system? What if the Illinois state pension is buying, a distressed credit fund? You and I are sitting here chit-chatting about BBB investment grade rated debt. But what if a pension fund, and they have for years been buying distressed credit funds, been buying private debt, private equity funds? So this is an illiquid investment that's supposed to last 7 to 10 years, call it. These are loans being made to companies that don't even qualify. They're not big enough to come to the capital markets. They're much lower rated than junk. And it's gone from a little cottage industry a decade ago to 1.3 trillion. Based on ... I wrote about this a few weeks ago. The private debt market is 68% owned by public pensions. Pensions have been sold SOLD, sold products over the years, trying to make up for, in return, what they couldn't get by being safe.
Mm-hmm. It's absolutely incredible to think about. And of course, goes back to the point that all of that stuff works great in a low interest rate environment, right?
Zero interest rate environment.
Right. Yeah. Danielle, one of the last things I'd like to touch on with you is your assessment of progress being made towards introducing a central bank digital currency in the States. And is there any way the big commercial banks will just roll over and play dead and let this happen?
Well, judging from the newswires today, nearly a dozen of the largest U.S. banks, MasterCard is in there as well, are teaming up with the Federal Reserve Bank of New York to roll out some kind of a digitized currency. So to answer your question, no. And it was, I think it was actually the CEO of MasterCard who basically said, this kind of renders redundant this whole CBDC discussion. We don't even have to talk about it because we're going to find a substitute for it and make it go away. Which I would posit that, that Powell, who's got several years left in office, every single time a Maxine Waters or Elizabeth Warren or an AOC has approached the Fed about, we absolutely must have a CBDC. We have to have a way to deliver modern monetary theory monies directly from the Treasury through the Federal Reserve to the people so that we can have more inflation. It's a must. Mm-hmm. Every single time this has been said to Jay Powell in Congress, his stock answer has been, we're at least 2 or 3 years out on coming down to how this is really going to work. Mm-hmm. Meanwhile, back at the ranch, they're setting up an out clause, an exit path for the biggest U.S. banks who are like, hell no, I'm not going to let all of my business go away. Mm-hmm. That might work in Nicaragua. It might work somewhere where the banking lobby is not as powerful as it is. And by the way, as integrated in the U.S. financial system mm-hmm. as it is. I mean, we've been going Venmo and the whole system's been being digitized, Apple Pay. It's not that there's a lack of progress in the United States. It's that there's not a political conduit to deliver universal basic income. Mm-hmm. And it's a distinction that's important to make.
Yeah, absolutely. And, when I, again, go back to trying to analyze and figure out the path forward for ideas like that, I think about the government trying to institute any program and how typically, bumbled it ends up being versus private industry coming up with something typically tends to be a lot more efficient.
I mean, obviously, the worst thing that could have happened to CBDC was the inflation that we received because we directly deposited money into people's bank accounts. It wasn't called a CBDC, but it acted like one. Mm-hmm. And what we got from that was massive inflation and overnight inflation that, by the way, hurts the people who are on the receiving end of the stimulus more than anybody else. Mm-hmm. I'm not making a political statement, but at least if the GOP takes the House of Representatives, then that style, that form of stimulus is dead, mm-hmm. at least for a few years, which is why there's a panicked release today. The Biden administration is considering an 8th suspension of student loan payments. 8th on January the 1st. I'm like, why not? I tweeted it out. Why not just put the damn thing on hold until November 2024 and just call it like you see it? Mm-hmm. We're going to put these puppies on hold until at least we get past the presidential election, as opposed to having an 8th, 9th, 10th, 11th, 12th suspension, indefinite, of student loan payments.
Well, and it's so interesting how it was, telegraphed to the population. We are going to be forgiving student loans. And then what was it? Like 2 days after the election, it was ruled that it was unconstitutional. So it just seems like such a game of words that is pretty easy to see through.
I mean, your most liberal Supreme Court justice couldn't look at the Constitution and say, oh, I forgot the administration has the power of the purse, not Congress. Mm-hmm. There was never an interpretation that was going to get past the Constitution. There was never an interpretation that was going to get past SCOTUS. It was never going to happen. But it was great sound bites before the election. And you know what? Some would argue that those sound bites were pretty representative because you had a ton of young people come out and vote mm-hmm. who thought that they were getting $20,000 forgiven.
Mm-hmm. Yeah, I was going to say they seem to be very valuable to that election, which we have somewhat yet to see how that's going to play out too, right?
Well, I mean, as we record, the GOP's one whole seat shy of taking over the House of Representatives, and it's obvious that the Democrats retained the Senate. So we have we have gridlock.
Mm-hmm. Yeah. Well, Danielle, I really appreciate you spending the time with me this morning. It's always a pleasure to speak with you and, try and keep up with you on so many different topics. Of course, more of your writing is available at quillintelligence.com, and your Twitter feed is excellent as well, at DiMartino Booth. Anywhere else you'd like to point to?
No. Usually I have my quillintelligence.com backdrop, but I'm in New York City right now, so I'm happy you gave me a shout out. Thank you.
Perfect. Thanks so much for your time today, Danielle.
Thank you. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.